Yeah, so this is the May 1st coffee talk, and we're just going to be doing a brief outline of our captive insurance program that we have, and do some Q&A on that a bit if need be, and then we're going to go through one example of what we see. In the meantime, Carol, once you get that sorted, let me know, but I'll give you guys a brief update on what's going on in the marketplace. Dicamba, for those that utilize dicamba, the market is quite sold out now, unless there's existing inventory in people's terminals. And generally speaking, it's from the day you order it, it's about 8 weeks away. I did do some checking, and I've got, I can bring up 1,000-liter totes, which covers an awful lot of acres, but I've got one of my suppliers has some in the US. But otherwise, in terms of case amounts and stuff like that, there's some inventory here and there. But other than that, it's getting quite short. So is carfentrazone and sulfentrazone in some instances. Again, these are the pre-seed products for that market. And I know some guys maybe are already covered off and whatnot, but if you have some just at the last minute needs, I would just communicate real quick about what you need. And then same thing goes on the in crop relating to the bromoxynol. Bayer has went in and purchased most of the bromoxynol that is available. And so whatever's available for existing stocks, there's a price for that stuff and availability mostly. What's most important, and other than that, there'll be a shortage of that. Another thing is that the bromine component of diquat for pre-harvest has gone up 7%. So that will be reflective of new orders. There are some existing inventories in place, and so we can I can help folks out with some decent pricing on that if you want to have some diquat in the warehouse. Our glufosinate, the 280 versus the 150, is going over quite well. And so we've got some folks that are taking advantage of that and getting it on their farm. Basically do around 1,400 acres a tote instead of the 735 acres a tote at the 1.35 rate. This rate is 0.72 liters per acre, so you can go almost double. And it's a low foam product, and the manufacturer has been utilizing it for 2 years, and we've had some very good feedback on it. And we did do a round of purchase for some semi-loads of the early order glyphosate 540 from one of my suppliers. That was a 450 a liter purchase, and that went well. And then lastly, we'll have some new stuff of that coming about. But it's all about communication. If you think there's something you need and you don't have it yet, let us know, and we'll do our best to help you. So with that, I'll turn it over to you, Carol.
Yes. Well, good morning, gentlemen. Yeah, I'll show you a little bit of that crop insurance I've developed for farmers, which has been beneficial for you in every possible way. And it is so dynamic that you can adjust it in every direction that will work for you. I came across this picture and I thought I'm going to add this, Dean, because it's almost like being stranded on an island, and you can either just write help in the sand, or you can build a raft to help yourself. So this insurance is pretty much where, yes, you're in control of the whole process. You're building your own raft to get off the island so that you can get more independent, rather than with traditional insurance where you're pretty much stuck in off-the-shelf requirements. So captive insurance is what it's called. It is basically, what is exciting about captive insurance is that it flips the traditional model on its head. Instead of paying premiums to external insurer year after year, you're keeping that capital working for you, tailoring coverage to your farm actual risks. It's a solution built for forward thinkers, those who want more control, more flexibility, and the potential to turn risk management more into a long-term financial advantage for you. In short, this insurance is your way. You customize exactly how you want it. So a little bit more about captive insurance is Captive insurance might sound like something only the big guys use, and historically that was true, but that's no longer the case. Individual farmers are using captive to take back control of their insurance strategy. Instead of sending premiums away to a traditional provider, you're essentially keeping those dollars in-house. You're managing your risks while potentially building your own wealth. And I'll explain that a little bit more in detail in our example. Currently, there's roughly about 5,500 captives worldwide. So it is not just a theory; it's a proven model that it's more acceptable now than ever in the agricultural sector to use that. And currently, the underwriting value for all these captive insurance is roughly about 20 billion in premiums that being paid annually. So it's definitely a big sector of insurance. So who can benefit from this? It's you as a farmer can benefit in every aspect of your types of farming, and even the intermediate suppliers, everyone that's dependent on farm yields for their income. So there's seed retailers and pea and lentil processors, or crop input suppliers, and even trucking companies can be included there. And of course, there's the big corporates that's getting involved as well: fertilizer companies, chemical companies, food companies, and even grain companies who can use this. This graphic highlights a little bit of the diverse toolkit we now have for managing climate-related risk. It's not just about traditional crop insurance anymore. We're looking at a full spectrum of coverage. So we can even include, if you've got any carbon credit, we can include that insurance. To parametric hail insurance is included, and there are other solutions that that we can tailor-make, that is more customizable and more flexible, according specifically to your needs. So each of these pieces basically represent an opportunity to customize your risk strategy to the realities of today's conditions. So we're including the parametric wind, hail coverage, and any other types you want to include there. Because, as a farmer, it never rains too much and then it rains too much. The wind doesn't blow and then it blows too much. No frost, and then suddenly out of the middle of nowhere, you get another batch of frost coming through. Ultimately, the goal is to put more control in your hands of managing that risk on the ground with any complications, where the impact is real and immediate. So the key benefits of captive insurance for your farm is one of the biggest advantage of captive insurance is that it's not one size fits all. Unlike traditional insurance, we're often paying into a pooled system that may or may not reflect your actual risk. A captive is built around your specific operation, your crops, your geography, your exposure. That means you're not overpaying for someone else's risk. You're paying for your risk and only your risk. It's a much smarter, leaner, more responsive approach to coverage, especially in this unpredictable weather conditions we've got. And captive insurance isn't just about replacing what you already have. You can also enhance it by adding a top-up insurance. You can fill all the gaps that traditional insurance might leave behind, where you can customize it so it evolve over time, and even pool with like-minded producers to create a bigger captive or something bigger. What makes it even more powerful is the fact that it's built on your own farm's data. not industry averages that might not affect your reality. That level of precision leads to better pricing and smarter protection. And here's the real kicker. In a good year, when you don't have major claims, you're not throwing that premium away. You're building a financial asset that stays with the operation. So 20% of your premium is carried forward to the next year into what I would call roughly your own savings account. So instead of the old you pay and maybe collect model, you basically create a long-term value, turning your insurance into more of a savings account or a strategic tool, not just a necessary expense. So although you can still, your insurance premium is still a deductible for on your expenses, and of course the CRA tax you need to pay, but it is an investment where you can get a return on that premium or the claims you don't make for that specific year. So benefits for your farm, as I just explained, there's potential tax advantages for you as well. And this is where the captives really starts to shine. And it's not just as a risk tool, but it's a full-on financial strategy. And with the right structure, you're looking at potential tax deduction on premiums while also building equity in your own insurance company. So that's a dual benefit you simply don't get with traditional insurance. Because what we do is we create your own little insurance company, and your own insurance company is no different to Saskatchewan Crop Insurance Company or to GARS, but it's something you own and you control it yourself. And because the assets are generally shielded from creditors, it also offers you a layer of financial protection you won't find in most farm risk strategies. And over time, all of this can help strengthen your balance sheet, which is especially important if you're thinking about expansion, succession planning, or even improving your access to financing. So I'm actually going to skip to the next one first. So is captive right for your farm? Captive insurance is not for every operation, and that's okay. But farms that meet this profile, it can be very powerful financial and risk management tool. We typically look at operations where the revenue is about 10 million or and a meaningful insurance spend, which is around 500,000 spent on insurance. But it's not just about size. Captives are best suited for farms that take a proactive approach to risk, maintain good historic records, and are open to working collaboratively with the captive management team. This is a long-term play and is not a one-size-fits-all, but for the right kind of operation, it's a way to gain more control, retain more value, and build something that strengthens the farm across generations. So what's the process to do that? So if you are interested, we can identify the risk, what you want to cover, and then determine your farm whether those risk potential gaps are. And then I'll do a quick premium calculation because we want to see what is your break-even value you want to do, and then work out the reinsurance premium. And if you're happy with that, then we go and set up your own insurance company. And if there are any claims, then of course you basically can carry a percentage of your premium forward to the next year for next year's premium. Does that make sense? Any questions so far?
The only thing I would add, Carol, is that there's that $10 million of gross receipts and or the 500,000 minimum of spend. And what we're in a place to do, and this is where iFarm can perhaps help a bit, is we can assist in pooling the smaller operations, if you want to call it smaller, but to get to the ideal metrics of size so that you can still participate in that pooling and building that wealth and all the rest of it. So we are more than happy to assist in that as well with the program. And that's where we can answer any questions about that when the time is right and how that would work. And then one thing, Carol, that I don't remember if we touched on it or not, but can you explain roughly the ratio of premium paid versus what the farm would be able to retain and reinvest?
Yes, so that's a good thing you mentioned there, Greg. Dean, I'll add that on. So your premium, roughly about 75% of your premium go to the reinsurance company because it's taking all the risk away from you. And then 20% stay in your insurance company's bank account. And the rest is a little bit of an administration fee for the first year to set up. So it's creating the insurance company. We need to do all the regulatory reporting on it. And so the possibility to move forward from to the next year is about 20% of your premium from this year. So your cash flow over time, then roughly over 5 to 7 years, will build up that you've got enough money in your insurance company. You don't really need to continue paying insurance because your bucket is so big.
Yeah, and so within that, I guess like one thing that was appealing to me is this really puts you in the driver's seat, just like where Sultan's sitting today, but in a similar way, where you are at the same level as what a Wawanesa would be, or an SGI would be, or a GARS level would be, and you're your own insurance corporation, and so you're paying yourself to be able to keep that margin in play versus those other guys getting it and all the rest of it. So that's one thing that's quite unique about it, where you can build that asset. And as you indicated, if you're keeping 20% premium, you have no claims in 5 years, you're at 100% coverage of that number of what you'd been paying out, and you can determine at that time if you want to keep reinvesting that money and getting interest on it and all the rest of it and going with the outside reinsurer, or if things are going in a state where you think you're good, and again, that money that stays in that account gets it's reinvestable as well, right? So you can get your X return on your own premium that you're putting into that separate account and all that stuff. So just a couple little points.
Yeah. Greg, do you have any questions?
You might be doing something at the same time. How about you, Sultan? Is that clear enough?
Yeah. So essentially, I'm paying into this, and my payment is, let's just say for easy numbers, $10,000 a year, and then 2,000 of that just goes into an account, and then after I'm 5 years in, let's say I don't have any claims, then I stop paying premiums. Is that what you're telling me?
Yes. Yeah. And you've got access to that bank account with account is your account. You've got access to it. Yeah. And of course the money, while it's lying in that bank account, can grow as well. You can use that money to reinvest it in other places as well, or use it as collateral while it's in that bank account.
So how am I getting covered for insurance? I don't understand. Like, for me to buy into something, I gotta understand how it works on the back end of it. So can you maybe just explain that a little bit more? Like, how am I getting insured if I'm not paying a premium? Does that make sense?
So yes, I understand that. So the first step is what we basically do is we work out what is your break-even value of and what it equates to the yield you want to cover, and then working out the premium according to how much you want to spend on it and cover. And then the next step is basically creating the insurance company. So the insurance company is the middleman between you. Your own insurance company is the middleman between you and the reinsurance company. So so all the risk from your insurance is taken away from you, where the money is reinsured. So as soon as you've got a claim, your insurance company inform the reinsurance company that there is a claim now for this policy, and the reinsurance company pays it out to where you want it to be paid. Does that make sense, Sultan?
Yeah. Okay. Yeah. And then as this bank account starts building up, then is that considered the money that you're going to use for the insurance? Is that how I'm understanding it?
So if the money builds up into the bank account, then you pay less premium every year. So in year 4, you only need to pay a premium of $2,000 because you already got $8,000 in there if you for your $10,000 premium.
Okay, but the insurance company that's insuring my insurance company, they're still active then in that?
Oh yes, they always active. They active every year with that policy. Yes.
How are they get paid?
So they get paid from
or
the
how are they? Yeah, and how do they? So as soon as that bank account builds up, that's kind of their risk premium. Is that kind of what I'm getting?
So the initial, so that $10,000 which you pay year 1, 7,500 go to the reinsurance company. So because that cover your if there's any specific loss claim that you want to make, and your insurance company then pay the next 20% if you make a claim. But if you don't make the claim, then it stays within your insurance company. So next year we carry your $2,000 forward for your premium. So your premium which you need to pay now this year is 10,000 minus the 2,000, so it's $8,000, and then the 7,500 is still going to go to the reinsurance company. And then year 3, your risk is falling so much that your premium is dropping more and more with the reinsurance company as well. But the amount you build up in your own savings account is getting bigger. And the same the following year, your premium drops far more, but the saving in your own account builds more. I can put an illustration together as well to explain that a little bit better, to show year after year what the cash flow advantages are for you.
Yeah, that'd be good.
Yeah. Because I know it's always difficult to visualize it if you it's a different concept and it's new, and it's easier if I can put it in a visual far better together.
Go ahead, Greg.
Gerald, would you be able to kind of, I think Dean used it the other day and I picked up on too, would you be able to say that your premium kind of works like a whole life insurance kind of thing? More or less?
Sorry, Greg, say that again.
It's like the insurance, like you have, if you go and buy a whole life insurance, you pay your premiums. After a while, your premiums, what you paid in there kind of takes care of your premiums. Is that basically what we're doing here, more or less? Can you?
So
Just on the premium side.
No, it's so captive. It's just a little bit different where it's your insurance payment which you make is not pooled at all with anyone else's. If you've got your own insurance company, it's only your own insurance company. And it is just the specific model which I've created with the reinsurance. If there is no claim, that the risk is going lower and lower and lower, that your premium will go lower as well, instead of your premium going up, which you've got with traditional insurance companies. Because traditional insurance company pool everything together. And every year they think, okay, they out of this pool, we know these people are going to fail, but we know this group of people are not going to fail. And where this is so different, where you've got your own insurance company, you in control for any claims you want to make, and the model just is based on your own data and your own risk, no one else's. Does that make sense, Greg?
Yeah, no, that I think I'm getting the hang of that. What so like for over our way, Carol, the basically the last 3 years due to drought and hail and whatever else we've claimed, and before that, part of the farm was always in a claim due to the drought. So what does that look like on this insurance?
Once again, I take your last 5 years yield, the amount of acres that you seeded, and we work out what's the break-even value you've got, and we insure it according to those values, and work out a premium specifically for that.
Okay, but what happens? Let's just say we stay in that. I mean, we can't always figure the weather out. Let's just say we stay in that weather pattern. And 3 years down the road, we're still collecting on this. What's that going to look like?
So your
3 years
premium,
time.
yeah, your premium is not going to go up year on year. It's exactly going to stay the same. And the fault level for claiming, you will never be penalized if you claim every year.
I think the thing to do there, Greg, is for your information to, like your what if statement from crop insurance, to come forward. It'll have your yield data on it and all this stuff. And Carol can do a what if scenario for you specifically based on your farm. And then we can kind of kick things around. And what's also unique a bit is there are some electives that you can decide to participate in or not that Carol's exploring. For example, loss of use insurance with your rigging, things like that. So we can start with the basic of just the crop in and out and yields and your target selling price. Come up with that number, and then we can modify things accordingly. And also that will include the percentage of coverage you need, right? So obviously that'll modify the premium level too. But it'd be great to get your information first, and then he can build that out for you.
Yeah, no, absolutely. It's just that time of year.
I know. Yeah, it's a difficult time of year. So I've got a link which I can forward to Dean and to share, where you can just stick all your information in.
Fantastic.
And then I can use that information to do the calculation from.
Yeah, same goes to you, Sultan. I'll maybe send it out to anybody, but we can shoot you that link. And then if you want to do your own confidential in-house assessment just to see where she'd be, then that gives you something really to look at, along with the other information Carol is going to pass along.
Yeah.
The other question I have for you, so typically on any insurance like this, you've got a time frame to have it done up in, like crop insurance.
Mm-hmm.
Any changes to your contracts April 1. I think Alberta's kind of like May 1 or something. So it's not like, so what's your date for having insurance in place because, of course, come August, we're going to have a pretty good idea if we've got a crop coming or not. And, there's still weather scares that can take that away. But do we have a date that this has to be?
Yeah, I can do it up to 45 days after seeding.
Okay.
Yeah.
Okay.
So was it June 15 that you have to have it in, or was it's actually from the date of seeding? Is there a drop dead date that's in stone?
There's not a drop dead date in stone, but it's roughly about, it's 45 days after seeding. I know Saskatchewan Crop Insurance has got the 15th of June, but it's like sunflowers, and camelina. Camelina, you just basically seeded your camelina. So, and what camelina 60-day turnaround. So
okay, that's cool. So basically a May 15th date of seeding for the crop, it would be July 1 as an example.
Yeah.
Okay. Good to know.
So let's say we start putting the numbers together, Carol. How long does it take typically to do everything? Throw numbers together, get your insurance company going and whatnot. Because obviously if we're looking at a June 15th or 45 days after, you can't go on the last day and expect to have everything done.
Yes, so the main thing is to get that quote out for the premium to you, and that you agree that's the premium you're going to commit to. And as long as that is committed, we've got our we'll have it. And then the administration bit, I'll do that as quick as possible. But the thing is, it won't be restricted in terms of your claims. As long as we've got that the agreement that this is the premium, this is what it's going to cover, it won't restrict any claims you've got.
So for a question or for a comment on that, I think what Greg was maybe trying to get to was, if we give you the information on May 1st, today, what is the timeline for you to get the calculations done and get a confirmation back that we are good to go, and we know where we're at? What would that be for a time?
A week.
About a week. There you go. Cool. That's not bad at all. Good.
Yep. Nope. Thanks for that.
Yeah, thank you, Dean. I need another cup of coffee. I think.
It's all good, buddy. You've been going hard since early morning with overseas calls. I understand.
Oh, goodness. You've got to laugh at yourself at stages. My goodness.
Good boy. Good. So that's great. Well, that's a good roundtable discussion. Now, you had an example, Carol, that you were interested in sharing that we were talking about before. And do you mind bringing that up, please?
Yeah, let me get that up.
I'm just going to shut off recording and start it up again very quickly. And then that way it's kind of separate.